Accountancy might sound complicated, but it's really just about understanding money. It's about knowing where your money comes from and where it goes. This is important for everyone, not just business owners. Think about your own life. You earn pocket money, maybe from a part-time job or from your parents. You spend money on things you like snacks or going to the movies. Accountancy helps you track all of this. In this guide, we'll learn about the basics of accountancy. We'll focus on 3 important financial statements: the income statement, the balance sheet, and the cash flow statement. These statements paint a clear picture of your finances, helping you make smart decisions with your money. So, let's get started. Imagine you're going on a trip. You wouldn't just hop on a bus without knowing where you're going, right? You'd want a map. Financial statements are like maps for your money. They show you where your money is, how it's being used, and where it's coming from. There are 3 main types of financial statements: the income statement, the balance sheet, and the cash flow statement. Don't worry, we'll cover each of these in detail later. For now, just remember that these statements help you understand your financial position. The income statement is like a diary for your money. It tells you how much money you earned and spent over a period of time. This period could be a month, 3 months, or even a year. Think of it like tracking your pocket money for a month. You add up all the money you received and you list down everything you spent. The income statement does the same thing but for businesses. It's called an income statement, but it doesn't just show income. It also shows your expenses, which are the costs of running a business. By looking at your income and expenses, the income statement tells you whether you made a profit or a loss. Let's break down the income statement into its key parts: revenue, expenses, and profit. Revenue is the money a business earns from selling its products or services. For example, if you sell handmade jewelry, your revenue is the money you make from those sales. Expenses are the costs incurred by a business in its operations. This could include things like rent, electricity bills, raw materials, and salaries. Profit is the money left over after deducting expenses from revenue. If your revenue is higher than your expenses, you made a profit. If your expenses are higher than your revenue, you incurred a loss. Understanding these 3 components is key to understanding the income statement. Section 5. Balance sheet, a snapshot of your financial health. The balance sheet is like a photograph taken at a specific moment in time. It shows what a business owns, also known as assets, what it owes, called liabilities, and what's left for the owner, which is equity. Think of it like taking stock of your possessions. You list down everything you own, like your bike, your phone, and any money you have. You also list down any debts you have, like money you borrowed from a friend. The balance sheet does the same thing for businesses, but on a larger scale. It's based on a simple equation: assets equal liabilities plus equity. This equation must always balance, hence the name balance sheet. Section 6. Decoding the balance sheet: assets, liabilities, and equity. Let's understand the 3 main components of the balance sheet: assets, liabilities, and equity. Assets are things a business owns that have value. This could include things like cash, inventory, the products a business sells, equipment, and even things like patents or trademarks. Liabilities are what a business owes to others. This could include loans, unpaid bills, or any other money that the business is obligated to pay back. Equity represents the owner's stake in the business. It's the difference between what the business owns, or assets, and what it owes, or liabilities. Understanding these components is crucial to understanding a business's financial position. Section 7. Cash flow statement: understanding the flow. The cash flow statement tracks the movement of cash both into and out of a business over a specific period. It shows how much cash a business generated and how that cash was used. Think of it like tracking the flow of water in and out of a bathtub. Water flowing in from the tap represents cash coming into the business. Water flowing out through the drain represents cash going out of the business. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. This statement is important because it gives a clear picture of a business's liquidity, which is its ability to meet its short-term financial obligations. Section 8. Common accountancy terms, a quick glossary. Here are a few common accountancy terms that you might come across. Depreciation, the decrease in the value of an asset over time. For example, a car loses value as it gets older. Assets, anything a business owns that has value, such as cash, equipment, or buildings. Liabilities, debts or obligations that a business owes to others, such as loans or unpaid bills. Equity, the owner's stake in the business, the difference between assets and liabilities. Revenue, money earned from selling products or services. Expenses, costs incurred in running a business, such as rent, salaries, or raw materials. Profit, the money left over after deducting expenses from revenue. Loss occurs when expenses are higher than revenue. Understanding these terms will make navigating the world of accountancy much easier. Section 9. Conclusion. Your journey to financial literacy. Understanding the basics of accountancy is important for everyone, not just for aspiring accountants. It empowers you to make informed decisions about your money and understand the financial health of businesses. Remember, the income statement tracks your earnings, the balance sheet provides a snapshot of your financial health, and the cash flow statement monitors the flow of cash. Don't be afraid to practice with sample problems and seek help if you need it. The more you practice, the more comfortable you'll become with these concepts. Congratulations on taking this important step towards financial literacy.